Hi, my name is Jeremiah Lane. I am a partner at KKR in the credit business, and I'm one of the portfolio managers of KKC. Today, we're going to take you through a market update. We'll take you through some performance attribution on the NTA of KKC since inception. I'll go over the portfolio positioning and our outlook for future performance, and then finally some plans that we have for the KKC structure. So let's first talk about the market overall. As you can see, since the bottom, March 23rd, earlier this year, markets have had an incredibly strong rally, but not all of the markets have recovered the same. The best recovering market has been the S&P 500, but that's really been dominated by the five largest technology stocks. Today, those stocks represent 20% of the S&P, and they've had an incredible run in the COVID era. The S&P 500 is up 10% since the start of the year. In the income space, the best recovering asset has been investment grade. Investment grade is about 4% up on the year, so fully recouping the losses that were experienced in the sell-off around coronavirus. Lower on the page, but getting close to the point, or in the case of high yield, just surpassing the point of recovery, you see U.S. high yield and U.S. loans. And then, at least at this point, not yet fully recovered. You can see Aussie stocks, the ASX 200, and Euro stocks still in that 90% of where they were at the start of the year. So a strong rebound, but an uneven rebound. Assets that have been performing best have, broadly speaking, been thought of as areas of safety, areas where investors can turn to reduce their risk. If we look more closely at the assets that we invest in, loans and bonds, you can see a similar story, a strong recovery since the peak and topped out at about 1,100 basis points. And today, depending on whether you're looking at loans or bonds, are between 400 and 500 basis points. However, still offer an interesting return. This is still wider than where we were when we were initially on the road speaking to investors about the opportunity in KKC in the fall of last year. If you go deeper still and look at the recovery by ratings, you can see even within high yield, the recovery has been very different depending on where you are on the risk spectrum. In the case of double Bs, you have fully recovered all of the losses experienced in March and are up about 4% on the year. At the other end of the spectrum, triple Cs, where we do a lot of analysis and have a significant exposure, the recovery's been a lot more muted. Today, triple C assets overall are about 90% of where they were at the start of the year. Significant recovery for sure, but much less than the recovery that's been seen at the double B end of the spectrum. And to our eye, there's a lot of gas in the tank still remaining in triple Cs, a lot of opportunity for them to close the gap to double Bs over the remainder of the year. Single Bs, where we also have a significant exposure, have rallied just about all the way back from where they were at the start of the year. They are behind where the double B part of the market is, but they have recouped most of their losses. Again, single Bs are a place where we have significant exposure. If you look on the left-hand side of this page, you can see our exposure over time. I think one of the most important facts of the positioning in the COVID era has been the increase we've been able to achieve in investment grade and double B. If you look historically at the 11 or 12 years we've been running opportunistic credit, historically we've had very, very low exposure to double B and investment grade because you just couldn't get the return that we were looking to deliver for investors at that point on the risk spectrum. If you were in IG, if you were in the double B part of the market, the yields just weren't sufficient. When you go back to March and April, when the entire market was dislocated, one of our favorite trades at that time was to participate in IG and double B rated securities because they were offering enough yield to be consistent with what we tell investors we can achieve for them. And we thought it was incredibly attractive to buy those lower risk securities and still deliver the types of overall return potential that we speak with investors about. If you look at our NTA, you'll see that it has had a substantial recovery, but not a full recovery. And I think that that is consistent with our exposure, our underlying exposure to triple C's and the way in which our portfolio is positioned. The NTA bottomed at 191 at the end of March. It began recovering. As you can see, when the NTA was around 216, we initiated our share repurchases in June, and through continued recovery of the underlying assets today, the NTA has recovered to 2.35. At this point, it's down about 6% from where we started at issuance. The unit price has been more volatile and has experienced less recovery. At the bottom in March, the unit price at 125 was down 50% from issuance. It recovered in the early stages of the recovery of the market. And when it was in that around 190 area, we initiated our share repurchases, which we were running through the month of June. In the month of July, we were required to not be in the market repurchasing shares as a result of a blackout period until we issued our year-end financials. Following the issuance of those financials, we've been able to come back in the market, but the unit price has settled in the high 190s, around $2 per share, despite the fact that we've been able to get continued gains in the underlying NTA. Here we'll go through in a little bit more detail the composition of the change in NTA since inception. Really importantly, when you look at this slide, each point in time shows the cumulative NTA to that point in time. So if you look at the March 2020 set of bars, you can see that on the asset side, our NTA had declined about 16%, and the overall NTA was down further as a result of some changes in our FX contracts. Fast forward to July 2020, you can see that the underlying investments are actually now positive since inception. Offsetting that has been the losses in the FX. When we were in the period of peak disruption and the assets had declined most meaningfully, we found ourselves meaningfully overhedged. We had hedges that reflected the initial NTA, and obviously the NTA had declined meaningfully. As a result, we were overhedged, and we made a decision at that point in time to mitigate the risk of that overhedge by taking off some of the hedge. But that came with some realized loss associated with that hedge, and it's that realized loss that continues to impact the NTA today and drives the bulk of the differential between the NTA at issuance and the NTA where it is today. The balance is really driven by the expenses that the fund has and the small amount of dividends to date and the incremental buybacks that we've been pursuing. If we take a closer look at KKC's current positioning, I think you'll see a story that is broadly speaking consistent with the way the portfolio was structured when we were on the road last year. We have a heavy exposure to senior secured debt instruments. We like these. They're first in line in terms of a recovery in the event that a company underperforms or goes through a restructuring. After that, we have an exposure to senior unsecured bonds. We're only participating in that part of the capital structure when we are able to validate the durability of cash flow and downside protection that is part of every credit underwrite that we do in this strategy. Consistent with how we were positioned last fall, we have a pretty balanced mix between fixed and floating assets. As a result, our duration, the risk that we have associated with underlying interest rates, is much shorter than the high yield market overall. And to the extent that in coming years we get a rate normalization period, we think that this will set us up really well to navigate through that. In terms of asset type, you can see that high yield and bank loans continue to represent the bulk of our exposure. You can see that we've had some growth in the other asset, and that's typically where we'll classify investment grade bonds. Investment grade bonds generally don't comprise a large portion of our overall investments, but in the COVID period, as I mentioned earlier, we were able to find some really interesting total return opportunities despite taking much less risk in terms of where we were in the credit risk spectrum. I'll spend time a little bit later talking about our sector exposure. We have been moving our sector exposure to take advantage of some opportunities that we've been seeing in the COVID era and also to reduce risk in some sectors that we think will be more heavily impacted and the market wasn't acting as though they'd be more heavily impacted. You can see our in the bottom middle, our ratings diversification, again, more ratings exposure at the higher end of the quality spectrum than we've had historically. And then in the bottom right, you can see our exposure to Europe. We continue to see the US as a more dynamic, more fluid market. We have a better ability to buy assets when they are falling out of favor, better ability to reduce our exposure to assets when we are changing our mind on the underlying credit risk. And so we continue to have a preference for the traded US markets over the European markets. As we look forward, KKC investors will get their European exposure through our investment in European direct lending, which we expect to begin to be drawn and funded later this year. Here I'll go a little bit deeper into the portfolio snapshot. I think that the key things I would call out are, again, that increasing exposure to higher quality ends of the risk spectrum in the lower left. That yellow bar and then growing in importance as you move from December to March to July. And the yellow bar and below, the highest quality stuff that we own, getting to be a larger part of the portfolio. That's really coming primarily at the expense of our single B exposure. On the bond side, in the bottom middle, you can see we've had a decrease in our exposure to loans. That's been offset by an increase in bonds. High yield, which is the blue bar, has been roughly stable, but it's our additions to IG where we've really been able to express that. We like the bond exposure in this market because as spreads compress, bonds have more potential for price appreciation. Loans can pretty much always be repaid at 100 cents on the dollar. Bonds, you can actually have a phenomenon where they trade at very substantial premiums to 100 cents on the dollar. And so we've been focused on the bond opportunity. In terms of sectors, I would call out two changes that we've made. On the consumer discretionary side, you can see a significant increase. That's really driven by our exposure to the leisure sector. And what we found was we analyzed these companies, many of which are heavily impacted by COVID, on the basis of the amount of time they could survive in a no revenue or low revenue environment. And we identified a significant number of companies that were impacted by COVID, but could survive literally years in a no revenue environment because of the cash that they had on balance sheet, because of the liquidity that they had available to them in the form of revolvers, and in some cases because of their ability to monetize trophy physical assets, real estate assets. And so we saw a really interesting opportunity develop where these were out of favor names because they were more heavily impacted. But they were coming to market and issuing incremental debt at a very bad time for them, at a time when it was very expensive for them to do so. So they were willing to pay a very high rate. And then further, they were coming with typically bond structures, which gave us some real call protection and some real opportunity to experience price appreciation to the extent that the market reaccepted those credits. And that's what we've seen transpire. We've seen the market reaccept many of those credits, resulting in substantial gains in the assets that we've been buying. On the other side is the healthcare sector. And while one might think that the healthcare sector would be experiencing incremental utilization as a result of coronavirus, what's actually been happening is as a result of people staying in their homes, they haven't been going out and doing the types of physical activity that might cause an injury, that might cause them to go to the emergency room. If they're only a little bit sick, in order to they prefer not to go to their doctor's office, where a doctor might be seeing patients that are positive for coronavirus. So people have really been choosing to avoid interaction with the healthcare system as much as possible, and that's led to some pressure on these businesses, many of which are fixed cost oriented, and we haven't seen the market charge much higher interest rate for that incremental risk. Even though they're experiencing some disruption, those securities aren't trading down to a lower overall price. And so it's been an attractive place for us to turn to reduce some exposure in order to fund the opportunities that we've been seeing on the consumer discretionary side. Next, I'll take you through performance that we see in the underlying assets. And we did some work comparing the recovery in the underlying assets in the coronavirus period to the recovery in the underlying assets that we experienced in the financial crisis when we were managing this same strategy. In the initial phases of the recovery, until really the market got back to the point where it was flat since the start of the disruption, our performance was similarly flat. But in the period after the market had recovered to even, the returns in the market started to taper, and the returns in the assets that we're focused on had much further to run. And so you can see in the period after the financial crisis got back to neutral, our assets ended up appreciating 26, 27% in the months ahead, while the market only appreciated about 10 incremental points, 1,600, 1,700 basis points of outperformance in that period after. And that's because those lower rated assets take longer to be reaccepted by the market. We think we're seeing the same phenomenon play out in the coronavirus period. Just like during the financial crisis, our performance has pretty much kept pace with the market as the market recovered to flat. But the market has recouped a lot of the pain from the sell-off. Those double B assets are now positive on the year, whereas our exposure tends to be more on the triple C side, tends to be more on the single B side. We think there's a lot of gas in the tank in those areas, and we think the days ahead are really bright for the assets that we own. I'll take you through a handful of changes we've made and next steps. These are really in response to investor feedback that we received. And the first is the move to biweekly NTA estimates. Initially, we had a more periodic update of our NTA. The investor community felt like we weren't providing enough regular feedback on how our assets were doing. We've moved to the biweekly NTA in order to respond to that point of feedback. We're providing more regular updates. We have those investment updates getting posted to our website. We're also kicking off a series of videos, of which this video will be the first one. We have new resources on the ground. We've hired a gentleman by the name of Nick Hyde to lead our client and partner group efforts in Australia and New Zealand. He's up and running in our Sydney office and will be available to respond to investor inquiries and interact with the investor base in KKC going forward. And then finally, we're in the process of evaluating some structural changes in KKC. So if you go back to how we originally designed KKC, it was very simple structure. We had two investments. We had an investment in our Global Credit Opportunities Fund, and then we had an investment in our European Direct Lending Fund. What we found during the sharp sell-off of coronavirus was that created some rigidity in the KKC structure overall. As an investor in GCOF, we're only intermittently able to withdraw funds from the underlying GCOF fund. As an investor, as a future investor in European direct lending, when that fund starts drawing capital, we will have limited ability to draw capital out of that because it's buying private direct loans. What we're evaluating is transitioning our investment in the Global Credit Opportunities Fund from a fund investment to an investment in the exact same assets, but holding those assets directly in KKC. That has the benefit of giving us a lot more flexibility to raise capital when we see fit. And one of the areas where our limited accessibility of capital has really impacted us has been in our ability to pursue buybacks. Because we have limited ability to take cash out of GCOF, we have a limited ability to pursue buybacks. When we hold the assets directly at KKC, that'll be a much more flexible decision for us to make. And so we think that's going to be an important change for the positive to the extent that we decide to move forward with that. Finally, I'll just go through some key takeaways. First, there's been an incredible recovery in the market. KKC has participated in that recovery, but the assets that KKC own also still have significant upside potential from where they are. We are more focused on the part of the market that has not yet fully recovered. And so we think that there is some incremental appreciation to come. Similar to how everything that we buy in KKR Credit, it's gone through our detailed credit underwriting process, our assessment of downside, our leveraging of the relationships that we have within KKR, collaboration with the private equity side of the house. And we think that these assets have very good downside protection. In today's market, the biggest risks that companies are facing are the risks associated with impacts to their business associated with coronavirus. Now that coronavirus has been present for 6 months, we have a real ability to assess how the virus will impact the companies that we're invested in. We think we're very well positioned to ride out any incremental risks that materialize with respect to coronavirus. Third, we're focused on cash yields that are higher than the market overall. So again, because we're focused on that single B, triple C part of the risk spectrum, those assets tend to have higher yield than the market overall. That's going to result in a higher cash flow and ultimately support our ability to pay the dividend in the future. And then lastly, we are taking steps to improve visibility with the unit holders, servicing of the unit holders in terms of distribution of information, and we're evaluating some structural changes to KKC in order to enhance liquidity in the KKC structure. With that, I'll just say thank you for your interest and look forward to future conversations.